Caledonia Mining is a Canadian company. We're listed in Toronto. Also SEC registered, so our shares are traded on the OTCQX in the United States. And we're AIM listed as well. We've been AIM listed for about 5 or 6 years, and we've seen this year a quite interesting move in the shareholder base from the North America to the United Kingdom. Our main asset is the Blanket Gold Mine in Zimbabwe, of which we own 49%. And that's a very relevant number because it means that we comply completely with the Zimbabwean indigenization requirements, which we're the only foreign-owned, previously foreign-owned mining company to have done that. The Blanket Gold Mine's a fantastic little asset. It produces 45,000 ounces of gold a year, very low cash cost, $554 an ounce. We believe it's the lowest cash cost producer in Africa, highly cash generative, with some great growth potential, all internally funded. And as a group, we've got $25 million of cash. They're all sitting out of Zimbabwe. And we're dividend paying. When we just announced a new dividend policy for 2014, paying quarterly, 1.5 cents a quarter, which puts us on a yield of 7.5%, which is very high. Indigenization is a policy of the Zimbabwean government which requires that 51% of any business of any size, I think it's over $1, has to be owned by locals. And so what we did is we bit the bullet on this transaction and we completed our deal in September 2012. And by completed, that doesn't mean we're talking about outline transactions which are sort of subject to heads of agreement, formal, legal, binding documents. And we're the only company to have done that. So our deal is done and it's finished. And we've received clarification of that several times from the government in Zimbabwe. We gave 10% of the business to the local community, which is important because working in Africa in often very poverty-stricken areas, it's important that the community feels to be benefiting from the mining activity that takes place on its doorstep. And so they're a 10% shareholder, and they, over the course of 2012, 2013, have received very significant payments, which is good, and it's much appreciated. Then we also then sold 10% to our workers, which again we think is a very strategic thing to do because it gives you gold congruence and buy-in and all that sort of stuff. 15% was sold to a local consortium of Zimbabwean business people who help us to the extent we want in terms of navigating the political highways and byways, which is something that's very useful to us. And then government bought 16%. The 41% that was sold for $30 million. We had to lend that on a vendor financing basis, and we're recovering that $30 million by the guys who bought it are sacrificing 80% of their future Blanket dividends. And so that will take some time to pay off. And that means over the intervening period, whilst those loans are being repaid, we'll be collecting something like 82% of Blanket's dividend flow, whereas previously, before we indigenized, we were collecting about 85% after withholding tax. We still control the business on a day-to-day basis. We have a management fee. And the Caledonia management team based in Johannesburg is actively involved in assisting the mine on a day-to-day basis in terms of its operations and its development. Well, now that we've indigenized, we're actually in a position to grow the business. Before we'd indigenized, we just didn't have the confidence and the security of tenure to invest money to grow the business. So having completed indigenization in September, we've now set about quite an aggressive growth strategy. We'll be increasing production from the current level of 45,000 ounces to 48,000 ounces next year in 2014, 52 in 2015, and the near-term target is 76,000 ounces. That's a nearly a doubling in production. We'll be investing something like $35 million to achieve that. That will be funded from Blanket's internal cash flows. But even if the gold price fell, we're still in the position to either sort of reshape some of the profiling of that capex, or if necessary, Caledonia could fund it itself if we felt that the opportunity merited that. Well, our on-mine cash cost is $554 an ounce, and that's labour, consumables, electricity, and the on-mine admin. But as everyone knows, on-mine cash costs hide a multitude of sins. And so we've recently adopted the guidance of the World Gold Council, and our all-in sustaining cost, so that includes royalty, it includes the group overheads, and it includes the capex that's needed to maintain the current level of production. So that all-in sustaining cost is about $873 an ounce. That's not a number that most other mining companies divulge, but we believe that the average for the industry is about $1150. So we're substantially lower than the industry average. A further cost metric is what people call the all-in cost, which includes the capital expenditure to grow the business. And our all-in cost is $999 an ounce. So that would mean that if the gold price fell to $1,000 an ounce, we would still be able to continue to grow the business. If the gold price fell to $873 an ounce, we could defer some of the expansion capex and the business would still continue to wash its face, but on a sustainable basis. Yeah, we've been in the dividend paying game now for 9 months or so. We paid our first dividend in January 2013, and that was just to start a dividend because we had to do some internal restructuring to put ourselves in a position where we could legally pay a dividend. So that first dividend of 5 cents a share didn't attach to any accounting period. The second dividend we paid was in April 2013, and that was a dividend of 5 cents a share, which formally related to the earnings for the year to 31 December 2012. Okay? Now, what we've just decided to do a week or so ago is we've just declared a new dividend policy, which means that we've increased the dividend from 5 cents a share to 6 cents a share. We'll be paying that dividend quarterly in 2014, and we expect to formally declare that first quarterly dividend in January 2014. The total dividend for 2014 is 6 cents a share. We've got $25 million in the bank. 6 cents a share equates to just over $3 million. So in cash terms, the 2014 dividend is well covered in cash terms. And consensus forecast, the Edison forecast for 2013, is about 28 cents a share. So 28, call it 30 cents a share. That means that the 6 cent dividend is 4.5 to 5 times covered by earnings. So by any measure you choose to use, the 2014 dividend is well covered and should therefore be quite secure. As we grow the business, as we just discussed, we're going to grow the business. That should hopefully mean that our cash cost either stays the same or perhaps even marginally comes down because a high proportion of Blanket's costs are fixed. So depending on where the gold price goes and depending on any other investment opportunities that may come along, that should hopefully give us the opportunity to potentially increase dividends as our profitability and cash flow increases. But as we stand here today, we're currently on a forward yield, a 2014 yield of about 7.5%, which we think is probably the highest yield of any gold company on a sustainable basis. Clearly there are companies out there which have dividends that may be cut, but as we believe we can hold our dividend and potentially increase it, we think that is one of the highest base level forward yields around.